Hey, good morning, everyone. David Nicholas here. I hope you all are doing well and you're staying healthy, staying safe. I just want to give you a little bit of an update of some of the things that I'm watching in the market this week. One of the biggest things that happened in the past couple of days was the yield curve inverted. So you may have seen the news about that. You may be saying, "What in the world is a yield curve, and what is inverted, but just a yield curve?" So we'll talk a little bit about it. But we did see some yield curve along the chain invert. Also, the president came out this week with his budget proposal. So I want to talk a little bit about corporate income taxes as well. Well, let's start with the yield curve. So I'll look at some of the headlines here. Let me share my screen. There we go. Okay. So let's do this. All right. So what you can see here is top stories, right? In the last couple hours is the 5-year and the 30-year Treasury yields invert for the first time. US 2 and 10-year curve below 8 basis points. Yield curve flattening. What is the yield curve telling us? So a recession warning, right? So I want to talk through what that is. But generally what happens is whenever the yield curve inverts, which means shorter term rates are now higher than longer term rates, that generally is a warning sign for recessions. We're going to look at history. I'm going to show you what that looks like. But let's just look at some of where rates are at right now. So if you look at, for example, what do I mean by short-term rates are longer or higher than longer-term rates? Take a look at, just for example, let's look if we can find something that's a curve that's inverted here. So if you look at here we go, the 3-year government bond. So if you go out and you say, you know what, David, I want something that's very safe. I don't want to take any loss. You can buy a government bond, a 3-year government bond will pay you 2.5%. Okay. But if you tie your money up for 30 years in a 30-year bond there at the bottom, you're going to get 2.508%. All right. So think about this. For 3 years, you get 2.53, but for 30 years, you actually get lower, 2.50. So why in the world would any investor buy a 2.5% yielding bond, government bond, and tie their money up for 30 years when they could go out and buy a 3-year bond for 2.5%? Well, here's why you would do that. If you as an investor think the next 30 years are going to be very dim economically, and that the Federal Reserve will probably have to lower rates to stem off recession in the future, you're good with tying up your money at 2.5% with the belief that economic growth is going to be slower in the future. So that's why whenever we say the yield curve is inverting, why does that signal recession? Because that's investors essentially saying, this is about as good as it's going to get in the next couple of years, but beyond that, right? So 10 years, 20 years, 30 years, we're seeing some issues, right? Or we don't think economic growth is going to be is not going to be to the degree that we're seeing now, and that the Federal Reserve is going to have to lower rates or take actions. And it may be that 5 years from now, if you want to buy a 30-year bond, you're only going to get 2% because the Feds are going to have to lower rates to stem off recession. So it's about locking in that rate, but it's really about a belief on what we think the future will be. It's because it's hard to imagine. Yeah, again, why would anyone tie their money up at 30 years at 2.5% when they can get more for a 3-year bond paying 2.5%? Again, it's for the belief that 30 years from now, economic growth will not be what it is today, right? There's some case studies for that. Japan saw low interest rates still for almost 20 years. So that's essentially what's happening. But why is the yield curve inverting such a big deal? So let's look at the 10-year and the 2-year. So right now, let's look back at our rates. 2-year rates are sitting at 2.34%. 10-year rates are at 2.4. So you actually do get a little bit higher rate for going out for 10 years. I mean, not much, right? You know, just a little bit, 2.3 compared to 2.4. But every time the 2-year rate has gotten higher than the 10-year rate, so we're not there yet. But look, if we go back over the last, what is this, almost 40 years, you can see what happens here. Whenever this goes below 0, that means the yield curve is inverted. So every single time over the last 40 years, 1978, the yield curve inverted. The gray areas are the recessions. We were in a recession in 1980. The yield curve inverted again in end of 1980. We were in another recession in early 1981. Okay, here we go again. The yield curve, you can see it going negative below zero. The 2-year and the 10-year yield curve inverted again in 1988. And guess what? You can see the gray shaded areas. The gray shaded areas are our recessions. There was a recession in 1990. So about a year or so, year and a half, March of 1989 to August of 1990. Okay, so about a year and a half later. All right, fast forward all the way to, guess what? January of 2000. Remember the peak of the stock market and the economy, the Y2K, the tech bubble. Yield curve inverted February of 2000, and guess what? We were in a recession in May of 2001. Look again, yield curve inverted in October of 2006, again, meaning that the short-term rates, the 2-year rate, we're talking about the 2-year and the 10-year, the 2-year rate was higher than the 10-year. Here we go again. Yield curve inverted in January 2007. We were in a recession by March of 2008. Well, what's interesting about if we look at a more recent period of time, so let's just do this over the last 5 years. So the yield curve actually just inverted in the fall of 2019. And what's interesting, we know what just happened right around the corner, right? Of course, we had COVID, the recession right around the corner. Now, did the yield curve predict COVID? No. So was that more of a coincidence? Probably. But what that tells us is there was already some concerns about economic growth in the fourth quarter of last year. We saw that play out with a recession. Here we are today. So we just look at the 1-year chart. So we haven't quite inverted yet on the 2-year and the 10-year, but it looks like we're getting close. And so this is why we're watching this very closely. If we see the 2-year and the 10-year invert, it doesn't guarantee a recession. But if you look in the last 40 years, it's been a pretty good tell as far as whether or not we're going to see a slowdown in the economy. So this is something that we're watching as well. Just briefly, I want to talk about the corporate income tax rates. The current President Biden's current proposal is to raise corporate taxes from 21% up to 28%. And I always joke about this. You know, if you want to start a pizza company in communist China, the Chinese corporate tax rate is 25%. So I said this on Charles Payne's show this week. It's cheaper for you to start a pizza company on Marxist Avenue than it is under Biden's proposal to have a pizza company in New York City. So just food for thought. But the goal is to increase corporate income taxes, not by a lot, from 21% to 28%, which would be one of the highest corporate income tax rates in the world. But what does that really do? And if we look at corporate tax revenue, this is what I've got on the screen here. Corporate income tax, when we tax corporations, that revenue amounts to about $360 billion, okay, on average. President Biden isn't calling for this. Even the most far left Democrats aren't calling for this. But if we doubled corporate income taxes from 21%, where they are now, to 42%, that's going to, let's just say that all things remain constant and corporations actually pay it. That would raise you double it. So you get another $300 billion in tax revenue. Sounds like a lot, right? Our federal government's going to spend close to $6 trillion this year. So even if we doubled the corporate income tax rate, that would only generate about an additional $300 billion. That's enough to run the government for about 3 weeks. Okay. So I think it's pretty clear. We don't have a tax problem in our country. We have a spending problem. You're not going to get our fiscal house in order by just raising taxes on corporations or the wealthy. You know, we can have that conversation, but to really fix our national debt and our deficit, we've got to reduce spending. So we'll see if cooler heads prevail come the midterms, but I don't think this new bill by the president has any legs to it. It's more than likely going to be dead on arrival. Well, again, I just want to give you a quick update. The stock market, like we talked about a couple of weeks ago, when I said Bitcoin and Tesla were bottoming, which was a very positive sign. I said that they were starting to take off a little bit, and I said that should bode well for markets. Well, here we are. So I think we're going to see some choppiness in the market. The S&P's come all the way back up to 4,600, all the way down from those 4,200 levels, which is very encouraging. I think where we go from here, it's going to be a little bit of a choppy sideways movement for the market. But I think in the short term, at least, I think the worst is behind us. Hopefully, we'll start to see some resolution out of Russia, Ukraine. If we can get some type of peace treaty or at least some ceasefire in the short term, that obviously will bode well for the people that are suffering, but it'll also bode well for markets here at home. I'm David Nicholas. If you have any questions, please feel free to email. So you can go to our website, nicholaswealth.com. If you're a client of ours, just know we are here to serve you. If you're not a client of ours and you have questions about your current investments, or you just want to talk to one of our advisors or CPAs, you can give us a call or you can respond to this email. I hope you all have a blessed and wonderful week. Me and my family are heading out for spring break next week. And so we're looking forward to some sunny weather and some family time together. But I hope you all, if you're traveling, be safe, have a blessed week. Look forward to talking to you soon. Bye-bye.